Hello and welcome to Building the Premier Accounting Firm. This is actually a podcast dedicated to the owners of bookkeeping, accounting, tax businesses to literally help you focus on those things that matter to grow the business, get the clients you deserve, and obviously get paid what you're worth. In this process, I have on the show each and every week experts and guests to really highlight a variety of things that you need to consider as you're running your business. And today's going to be a great discussion. I've got Brian Bingham here. He's the Vice President of Madison Specs. It's also known as Social Media World and is the Cost Seg Cowboy, which is a division of Madison Commercial Real Estate Services. In 2017, he joined the Madison team for the cost segregation department at Madison Specs. He happens to be a person that really speaks a lot about this. He's spoken at over 50 events in the last 5 years, bringing awareness to and education to the highest levels of tax-related benefits regarding commercial real estate. Madison Specs actually is a company and where they've focused on this. They've done over 16,000 studies in all 50 states, saving over $2 billion in accelerated credit tax depreciation credits. And Brian has, just for himself, earned a Bachelor's of Science degree from Texas Tech University and completed his graduate work and received his certification at Albany Christian University back in 2008. So Brian, welcome to the show.
Yeah, thanks for having me. Appreciate it.
Yeah, this is going to be a lot of fun. I just really kind of enjoy the tax side of things. I think this is one of those areas of business that we can really dive a lot more into. But before we get into the specifics, give us a little bit of a background of how you got into the accounting world.
Oh, sure. So, I've been involved in real estate for over 20 years. I mean, I might look young, but I'm young at heart. Let's just put it that way.
Okay.
But involved in real estate, whether, brokerage, management, training, et cetera. And I really got into the depreciation and the tax side of everything about 6 years ago. Honestly, it was kind of a coincidence. I came in, I owed a lot of taxes to the IRS. I said there's got to be a way around this. And at the same time, I found the company Madison Commercial Real Estate, which had a division, Madison Specs. Specs stands for Specialized Property Engineering and Cost Segregation. And from that, I discovered how much less I can pay in taxes based on the real estate level. And since then, it has been a whirlwind of fun, stress, and enjoyment, figuring out ways for not only myself, but also my clients to not, legally not pay taxes. So since then, it's the best job in the world.
So obviously your background is more in the real estate. I'm assuming more the commercial side of things. Is that right?
That's correct.
Yeah. And so there is a lot to be said about cost segregation. For those people that aren't familiar with it, just in layman terms, what can we understand that to be?
For one, you can cross out cost segregation. The best way of looking at it is accelerated depreciation.
Good.
So essentially what we're doing is you're taking a simple building, whether it's a residential or non-residential, that's income producing property. Mm-hmm. And you are essentially just separating the assets that are physically at that property. For right now, you take a building that has all the furniture, all the landscaping, everything included. So, tax law, you have to divide that by 27.5 for residential or 39 for non-residential. And that's what you're getting in depreciation every single year. Doesn't sound bad, but in the long, run of things, they're here to make money on this property year over year. You want to increase that profit. So getting the same amount of losses every single year is not going to cut it. So with cost segregation, we're simply taking and reclassifying all the assets, things from the inside, the carpeting, cabinetry, lighting fixtures, window treatments, et cetera, and we're simply moving them to their own life expectancy, according to the IRS, their own life expectancy.
Now, some of the things that I think are very important here is obviously the listeners are tax, accounting, bookkeeping type individuals. And so they may be working with clients that happen to run businesses where they have these investment properties, whether they're commercial or residential properties that they're doing for short-term or long-term rentals. As they're looking at how they can accelerate the depreciations, one of the things that they need to consider is if I'm going to renovate the property, there are some decisions I can make that can actually impact whether or not things can be accelerated. Isn't that right?
That's correct. Yeah, absolutely.
So if I'm wanting to work with an architect or I'm looking to work with a landscaper, an electrician, I'm going to be putting in certain lighting, as you had mentioned, the carpeting, the flooring rather. There are certain things that are, as per the IRS, worth accelerating. Others, you just don't get that advantage. Can you give us a few examples of what those might look like?
Yeah, for sure. Absolutely. So really just look at it as real and personal. So, real property is what we consider structural based. Things like windows, walls, roof, and foundation, the things that actually make up the structure of the building that keep it and help it stand and operate. The remaining assets, we actually have to place, essentially there's three different life expectancies. There's a 5-year, 7-year, and 15-year. So 5-year property is things that depreciate over 5 years, or they have a life expectancy of 5 years, and that's inside. And what I was saying earlier, the carpeting, window treatments, appliances, etc. So we're moving that from years, instead of averaging it out over 39 years, you're moving it to years 1 through 5, vastly increasing the depreciation losses. All right. Then your 7-year is your owner-operated equipment, and you find that in things like car washes and restaurants, like the kitchen equipment, things like that, years 1 through 7. And then the 15-year category is your exterior land improvements. And these are things added to the land on the outside, like landscaping, fencing, driveways, asphalt, carports, pools, if it's a residential. The big key factor on all of these is what we're not taking away the depreciation. I mean, we're not giving you less or more depreciation. We're simply moving it up front because it becomes a time value of money scenario. You want to take those losses up front instead of waiting decades for them towards the end.
Yeah. So the way I've learned it or understood it is, rather than taking and depreciating it out over decades, knowing that I'm going to renovate maybe every 5 years, I can take and leverage that accelerated depreciation. Knowing that I'm going to replace that machinery over 7 years because of the wear and tear, I can basically leverage that and accelerate it. Looking out at the exterior, being that I'm going to have to maybe redo the landscaping, put in new trees, whatever the case may be, fix the outside with the exterior, such as the siding. Those things are a little bit longer, and that may fall into that 15-year category. But now, instead of decades, I'm getting it down into more years, and I'm reaping the benefits of those. Is that a good summary?
That's a great summary. And matter of fact, more on that point, it kind of comes to, I guess what you want to call is like a hidden gem for you and your listeners. The idea is you can do cost segregation just one time on the purchase of a property or the acquisition. Okay, so you can take everything as the property sits and immediately take that depreciation. Now, let's say over the next year, you're adding those improvements that you're speaking about. You're adding additions, you're adding renovations or TI money, whatever. You're adding to that property and removing things that we have already captured from the original study. Now, the nice thing about this is you can look at it as icing on the cake or a cherry on top, because you're taking all of those additional improvements and added values, and you can actually do another cost segregation report and sort of refill your losses, refill that bucket. So that's the idea, is you can, anything you're adding to the property, you can immediately take again and again and again for years and years and years. You can do as many improvement studies as you want, and you're just adding additional value to all of your clients by saying, look, I've got a way for you to refill some losses for your tax returns. This is how we're going to do it.
Now, is this what you would refer to as a bonus depreciation?
So the bonus depreciation is actually kind of a little bit separate from that. The bonus depreciation is the new, tax law, the Tax Cuts and Jobs Act of 2017. And it basically is saying that any assets under a 20-year life, and that's all that 5, 7, and 15-year assets that we were talking about, anything under a 20-year life, you're actually able to take and move to the first year of acquisition. First year, the property is placed in a service. And we're talking in some cases 10x or even 20x the amount of depreciation that you would have gotten from a cost segregation report. You would take year one. And the beautiful thing about this is it trickles down to every investor involved in that entity that's purchasing the property.
So when I'm looking at properties and I'm considering doing a new build versus an existing property that I'm going to acquire, is cost segregation more beneficial to the newer build that's going on or the one that I'm acquiring that's been in place for years?
So it's all based on your personal tax return liabilities, correct? So the idea of doing a new build, placing it into service and immediately doing cost segregation on it, you're basically just doubling or tripling your tax losses on that property. Now, most new developments that are placed into service, they're already going to be operating at a loss until they start filling it up with new tenants or increasing rents, et cetera. So the idea of adding those additional losses comes down to, what do you need all of that depreciation for? Yeah. Some people like to spread it out amongst other properties they own. And some people just like to hold on to those losses in case they have a taxable year coming up soon. So really, I would say on a value add property, that's where the benefits will come, come tenfold to you, because you and anybody else, any other investor involved in that property, gets to take those tax depreciation advantages immediately, and they can just constantly roll over what they don't use year over year over year.
Okay. And then if I'm looking at selling the property, meaning I intend to take possession of it this year, but maybe I'm going to sell it in 3, 5, 7 years, does it matter that I'm intending to actually flip it within so many years? And does that change the strategy at all as it relates to cost segregation?
So typically, we always suggest, if you are going to do cost segregation on a property, you definitely don't want to do it on a fix and flip. Essentially, if you're planning on owning that property longer than 12 months, then cost segregation is a no-brainer, because you're going to take all those tax advantages and depreciation and utilize it immediately. With something like a fix and flip or something you're planning on buying, renovating very quickly and selling, within that 12-month period, you're really just not going to see those tax advantages, because they're not going to be able to take care of the income, eliminate the income from that property. Now, it would be fine. You can kind of do the Trump method, and that's basically buy a property knowing that it's going to have these large amounts of losses, and then spread it out to your other properties that are doing very well. So that's why this entire ordeal is called tax strategy.
That's exactly right, which is why we're having this conversation.
Exactly.
So the other part of this, and I'm going to go back to the bonus depreciation just because I think this is relevant. There's a Supreme Court hearing that is now going to be taking place as it relates to the Tax Cuts and Jobs Act. It was more related to foreign taxes and so forth. Do you see that affecting this? Do you see this changing in the future?
So it's not going to affect it. I know what you're talking about. It's not going to have any effect on the current status. Now, there is also talks of putting this back in the nation's hands on whether or not to restart bonus depreciation, because I know we're talking about bonus and some people might not have heard this before. So just to kind of recap on it, bonus depreciation allows you to take anything under 20-year life all in year one. Now, from 2017 until the end of last year, 2022, you could take 100% of those assets in year one, those tax losses. Now that we're in 2023, you can take a maximum of 80% of all of those assets up front, and the remaining 20% is rolled into the next year. So year over year from now until 2026, it's going to drop 20%. Year over year. So next year, you only allowed a maximum of 60%, and then 40%, 20%, and then it's gone. But there are talks right now, actually, in Congress that potentially they could restart it from 2023 until 2025. 100% bonus again, because of how well it actually was brought on for all the real estate investors and the economy over the last few years.
Great. This is wonderful. Now, one of the things that I'd like to know is, the cost segregation report, to try and assess what you can do and kind of get prepared from a tax strategy point of view, when's the best time to actually prepare one? Before purchasing the property to assess it as part of the transaction decision? Is it once you've purchased the property to see where you stand? What are your thoughts about all that?
Well, honestly, you can do it just about any time, as long as you have three pieces of information: the address of the property you've purchased or willing to purchase, the close date or projected close date, and a purchase price. I mean, literally from that, you can have an estimate done. You can have the percentages, the numbers, what we estimate you can pull from it and move forward in bonus depreciation or cost segregation spread out. As well as straight line depreciation. You want to have all the examples in front of you to make the best educated decision on how to move forward with your tax strategy.
Okay.
I always tell people, like, here's you have to, when you do cost segregation, you have to do it when you own the property. That's a must, because if you don't own the property, you're giving tax benefits to somebody else. If you've owned that property for years, and this is the first time you're hearing about cost segregation, you can still do it. And we would base it on the original close date, years ago, and you can take advantage of it now and push everything from the future into the present.
Yeah.
And then there's also, if you have a property, let's say you just got under contract and you don't close for 60 or 90 days, you can still get cost segregation estimate done. And you can actually break it down if you have investors. You can break it down and tell your investors how much in returns plus losses that they would get based on an investment. So, numbers don't lie.
So some people listening might have clients or themselves working with, say, Airbnb type properties. So not necessarily a second home, but it is a commercial type venture on their part. Is this something that they ought to be considering as they're looking at that home as a revenue type opportunity? Oh,
absolutely. So it's kind of interesting. The short-term rental homes have a hidden, I wouldn't still call it hidden. It's very well known, but a lot of people don't really think too much into it. But short-term rentals, even though they're technically residential properties, they are considered non-residential based on the how they're short-term. So they're retail scenario. Exactly.
Yeah.
So basically, any losses, whether it's straight line depreciation or cost segregation or a bonus depreciation, you can actually take advantage of and apply to your active income level. That means if you have a W-2 or a 1099 or something like that, you can actually apply these losses towards your personal tax return to pay less in taxes.
No, this is wonderful.
Everybody needs to at least look into it. That's the idea. You try to live by the whole mantra of you never know until you ask.
Yeah. This is one of those things you just do, and if it doesn't apply, you just check it off as I've checked, right?
Exactly.
Yeah. Now, here's another thing that I think is worth discussing. The size or the value of the property in question. Is the cost of having the report run as the cost of the tax preparation worth it for a certain value and above? Which is to say, if I'm buying a property that's, say, $400,000, it's definitely going to have fewer cost segregation opportunities because of the different amenities and so forth in the property than compared to maybe a $3 million commercial property. So is there some thoughts as to a threshold that's worth considering that triggers it?
The interesting thing is it used to be, years ago that absolutely you wouldn't want to do anything under $500,000 to start with. Now it's become such a streamlined and almost necessary thing to do for all these commercial real estate properties that I've been doing studies for individuals for $100,000. Somebody bought a residential home for $100,000 and they saw mass tax benefits on it. So the idea is it's not about how much, it's not about how big, it's just about can you use those losses to benefit. So again, goes back to the mantra, you never know until you find out.
Exactly. You just need to check it. Another example that might be familiar to some of the people is there are properties where you can purchase as an investor a portion of it. It's not a timeshare type thing. I'm not going that direction. I'm referring to like an Airbnb type property. It's $1 million home. You get 8 investors, and they're all paying $120,000, and they're getting a fraction of the value of the home. But obviously, the cost segregation would trickle down to each of them as individual investors. Correct?
That's actually funny you say that. That's what I call it, the trickle down effect.
Yeah.
So that is exactly right. So the idea is when you invest into a real estate property with multiple investors, you are buying an ownership percentage of the entity, whether it's an LLC or a corp or whatever, that's purchasing that property. So you, in turn, let's say you invest and you get 10% of the ownership. That means you get 10% of that depreciation that's available to you based on the purchase price, not your investment, the purchase price. So you do still, I've seen people get from, an investment of $100,000, they'll get anywhere from $50,000 to $100,000, and in some cases, it's all based on your calculations, your lending terms. Over 100% of their investment they'll get back year one in losses for depreciation.
That is fascinating. Is that more of a reflection on the fact that the property is being renovated, or is that the fact that it was recently renovated? What was one of the determining factors on that?
Honestly, in terms of that scenario, it is nothing to do with the property at all. It has to do with the lending terms. Okay. It's all based on how it's broken down, how much down payment you need, how much the purchase price is based, entirely on that. I've had some people that include preferred equity in a deal that essentially lowers the capital raise, and then those pref equity investors don't take any depreciation, which means all that additional depreciation goes to all the passive investors or limited partners in the deal.
Nice.
So it becomes a huge incentive for people to come out of the woodwork and say, look, I need tax losses. I need a tax shelter. I'm putting my money in this deal that's going to give me those losses right now.
Yeah. Fascinating. I'm sure a lot of listeners saying, sign me up. So this is fun. So the other thing that I'd want to point out is there's definitely an accounting perspective to all of this. I'm an accountant CPA. I'm over here working with my clients, whether they're doing this for their own business because of the business property that they own and run their company out of, or they're investing in some building and such. But I'm the accountant. This is, let's say, either something new to me or something I'm not doing very, very often. What advice would you have to me as an accountant to at least understand what I should be telling my client, introducing to my client? What are some of the things I need to be aware of as I'm working with them from an accounting perspective?
Absolutely. So as an accountant, CPA, or tax preparer, how often do you get the chance to be the superhero to your clients? I mean, the idea is one of the greatest perspectives on cost segregation is it's something that a lot of people that have been in this industry for years, just like myself, did not know about coming in. So the idea that you can actually bring to the table something that says, hey, look, I want to see if this works for you because I want you to lower your tax liability. So really all you need to do is get it looked at, have a quote run, have an estimate run, whatever. Show your client that, look, I found a way. It might be small, it might be big, for you to have less tax liabilities. Here it is. What do you think? So basically, you're bringing something to the table that they might not have thought about because it's showing a full transparency that you care about it, which you should, that you care about saving your clients massive amounts of tax money.
Perfect. No, this is great. And then regarding tax preparers, lots of them are obviously in the tax preparation side. They're doing the tax preparation, whether they're doing it during tax season, extensions, and so forth. And they may be intrigued by the opportunity to get involved in tax planning, which cost segregation obviously falls into. So from a tax planning perspective, I'm a tax preparer. What are some of the additional things you could share with us that might be helpful for someone to go into this tax planning opportunity? Who could they target as potential clients? How could they leverage the cost segregation services being something that they would include?
Sure. Yeah, absolutely. So really just listing the cost segregation services, whether it's on a website or documents or marketing material, just having that as a bullet point separates you from so many others out there. Basically, you're telling them, look, I'm heavily involved in real estate now, just by listing cost segregation, accelerated depreciation. The Again, the whole concept is being transparent with your clients. You can very easily tell them, look, if you have real estate, whether it's a single family home or even a condo that they're doing an Airbnb on, to multiple properties. The idea is if they have these properties, you know right off the bat that they're going to have losses and depreciation available to them. Now it's just a matter of finding out how can I apply that to their current tax liability situation. Yeah. So that's where you have a team that's like me, that's on there to actually help you through that whole stage to see if it works for your clients and makes you the superhero.
Yeah, the beauty of that is I really do like the idea of listing cost segregation as a service to provide, because as a tax preparer, that's going to give me an opportunity to work with a different type of clientele. The type of individual that's going to be in their tax return taking advantage of cost segregation is a higher caliber client, and they're not just a traditional 1040. They're someone that has investments, and it's a little bit more of a lucrative tax planning opportunity, and the tax preparation I'll be performing is a lot more lucrative as well. So it's definitely a clientele that I'd like to be drawing into my practice and begin working with. And just to give you an idea, as a listener, one of the things that I think, Brian, I'd love you to kind of clarify is it's not that you're wanting to take these clients from the accounting professionals or the tax preparers. This is a service you provide in order to assist them in doing the tax preparation that they're performing. Isn't that right?
That is absolutely right. So the idea is I can't do my job without you guys. So we're not going to file tax returns. We're not going to list out the strategies for your tax preparation work for your clients. If anything, we don't even have to speak with your clients directly. We would speak with you and you'd be the middle person. There's even something that we do. We actually can do reports, entire cost segregation reports. And these things are like 75 to 150 pages long. And we would simply put your logo on it. And we will do all the back office work. The idea is we just want to make sure that everybody involved in real estate actually takes advantage of this, regardless of our involvement with them.
And as a cost, I'm assuming that it's correct to say that this would be a pass-through, meaning you would actually invoice the tax preparer and they would just add it to the fees and services they're passing along to their clientele. Is that a fair summary of what would happen?
That is a fair summary, absolutely.
All right. Now, just to give us some cost idea for a service like this, you're talking about a pretty extensive report. You're talking about someone physically going out and assessing what those depreciations may be on that said property. What are we talking about as to timeline to get a specific report for a property, and maybe the average or typical type cost? I'm not asking for a quote, but just to give us some ballparks here.
Sure. So process-wise, if you wanted to start with, here, Brian, here's the information, I like an estimate. It takes 24 to 48 hours to get an estimate back to you. If you decide to engage, and we finish the process, it typically takes anywhere from 3 weeks to 6 weeks at the longest that I've ever seen. And that was for a massive property. To actually have the report in your hands in draft form. The draft form is so we can make any extra corrections or any additions that would be very beneficial to increase or make sure it's all completely audit proof, essentially. And then cost-wise, I've seen anywhere from $1,000 for a very tiny small property up to I recently did a 32,000 acre hunting ranch, and we did that one for $20,000.
Love it. That is awesome. I hope you got to go enjoy the ranch.
I did. I actually, believe it or not, I told them, I'm the cost seg cowboy. I told them, look, I would love to do it as long as I could bring my fishing pole. And they said, absolutely.
Very good. All right. So that gives me a great opportunity to segue into some examples. I've heard some amazing stories as they relate to cost segregation. Some of them were basically stories about, instead of putting in this ceiling tile, putting in this ceiling tile, instead of doing this electrical conduit on the wall, we're going to have these outlets over here. It was regarding outside tiling for retaining walls. It was regarding different plants. It was regarding different flooring. Give me some stories here just to kind of illustrate how the IRS code really does impact and determines whether or not something can be accelerated.
Oh, for sure. So going off of all of the assets you're talking about, that's one downside to being involved in this industry. I can no longer look at a property
building
and say,
the same way.
Very pretty. It's very pretty. I like it. No, now I go and, oh man, I'll bet you can take that for 5 years, that for 15. Yeah. So really, it's anything that has curb appeal is one of the best ways to describe it. So if you're adding retaining walls to separate landscaping, you're putting nice decorative doors or a signage all over the property. Everything that has a curb appeal to it, that's what you're going to get back in depreciation, in the losses, in the depreciation immediately. Now, things like if you were going to go in and you need to repair the foundation or replace the roof, those unfortunately have a longer term. That's the 27 and a half or 39 year. You cannot accelerate that up front. But when you're looking at different ways or different things to add in to really increase those losses, that's where energy efficient, efficiency items come into play. So solar panels have immediate tax capabilities towards the depreciation. Or, what is it? I literally just had it. Anyway, it has to do with the solar windows scenario. So technically, if you put in solar windows or solar window treatments, they get completely different tax benefits, and they can make it go year one. So there are lots of loopholes and hidden gems involved in the depreciation world that can assist everybody.
Yeah, one of the things that I learned, and by no means am I an expert, it's just the fact that as you're considering, especially in a renovation, what you want to do, it's very important to understand from a cost segregation which things are depreciated quicker, because you may choose to do a different flooring than you were intending originally. You may do different lighting, as you mentioned, windows. It's the same with the outdoors, this retaining wall versus this lighting versus this shrubbery. And all of a sudden what happens is you really just have a totally different perspective, like you were describing. It's kind of like, I see it as the Matrix. Instead of seeing things as they are, you see these digits that are falling, and you're looking at numbers and numbers and numbers as you're basically walking past a room or walking in a building. So the other thing I'd like to ask is, can you share with us a story of someone that actually had this done and just really kind of the benefits of processing it, maybe the surprise associated with what they learned?
Oh, sure. So let's see. I've got one of my first clients that I ever worked with. They were big syndication, which is apartment syndications, like we were talking about with getting investors to invest in an LLC that's buying these large multifamily properties. He and I met at a networking event, and I talked to him about cost. He had no idea what it was. He's been in the industry for years, just like me, and he had already bought 7 other multifamily properties in the past 10 years. This is his 8th one. That's where I was talking to him. Why don't you let me do a cost segregation report, and let's see what we can do on it. So long story short, before cost segregation, he was going to have about $900,000 of depreciation losses for that year, and this was in 2019. So for that year, I did the cost segregation report. Now he was going to get, with bonus depreciation, $8.9 million year one. So wow. He put up his hands. He's like, all right, so $890,001 for not doing cost seg, or $8.9 million in the other. Needless to say, I ended up doing the other 7 properties with him as well, because the idea is he was now giving all of his investors an extra bonus with these additional depreciation. And since then, we have done about 22, 23 properties together, and he is yet to slow down. And he loves the idea that you can take these and distribute them out to your investors. He loves the idea that you can tell his investors before they actually put in their capital what you can get in that depreciation. So it's just the best of both worlds, and that's how we originally got it going.
That is a great example. I appreciate it. So the other thing is, I'm curious, is there kind of like a best case? Like you've got A properties for business, commercial space. You've got B properties. You've got a strip mall, maybe a duplex versus a sixplex. Are there ones that have more than others? Is there like a sweet spot for this whole process?
Oh, sure. I mean, every type of property has something. There is, just for reference sake, there is no such thing as a cookie cutter in the entire industry. So I've seen everything from, we're talking millions upon tens of millions of dollars in tax depreciation to tens of thousands. It's all based on the original purchase price. You have to have a basis. So that purchase price minus land value, because land is something that cannot be depreciated.
Yeah, good point.
Basically, your basis from that purchase price minus land is what determines how much you're really going to get. Now, properties in general, like what has better results than others. I mean, honestly, you can go from the very top, which is usually car washes, manufactured housing developments, breweries or vineyards, things like that have tons and tons of stuff associated to make it, production or manufacturing. All of those have massive amounts of depreciation available. Now, lower things like, let's say, warehousing. Warehouses are simply shells of buildings.
Good point.
So if they're shells, that means that's long-term structural depreciation. There's not much there to really accelerate.
Yeah, what I thought you might say, and you actually have addressed it, is your A listing is going to be with the cosmetic type stuff, the fancier doors, the more expensive lighting, the more expensive flooring. You're going to find that those accessories are what you're going to be depreciating. But when you go to a shell of a business that's just a warehouse, there's nothing there. I mean, it's just the roof and the walls and maybe some windows and a few doors. And there's just not much there because it's intended to be a cement slab where people are going to be storing things and so forth. So there's not much to necessarily write off. So that distinction, I think, is helpful in this conversation just for the listener to understand.
Absolutely.
As they're working with clients, where might be that gem, that opportunity with a client that I've got to bring this up and say this is something we ought to look into. The other thing I want to do, and I'm going to switch gears on you, Cost-Seg Cowboy. Tell me about that. How did you get the nickname?
It's funny, speaking on stage over the years, I've had a lot of names. I've been called I've had the tax ninja, the tax wizard, the magic man, you name it. But somebody the other, a year or two ago said, "Hey, Brian, I love the idea that you can educate and train not only on stage, but also in person." And these are times when I would actually physically go to the properties to point out, this would be good for this would be good for that. And one day it was in Texas, it was hot. I was wearing my jeans, boots, and cowboy hat. Okay. And it's stuck. Now it's become, when I'm trying to do my educating or, showing my experience and expert level expertise, I like to do it in person. So I like to actually lead by example and point out what you can take, what you should do. Here's a strategy. Have you thought of this? And people are just like that. He's got boots on the ground. So now it's like boots on the ground with the Cost-Seg Cowboy has become this trend.
Well, it's a good nickname, and you should own it. I like the idea, the cowboy, and the fact that you ended up on a ranch. That sounds even better.
Oh, absolutely. I always, guys, there's nothing off limits. Even if you think it's just a patch of land, you never know until you actually look at it.
Nice. All right. So with regards to this, any advice that you would have for the accounting professional as they're learning of this and considering this for their clientele, perhaps even for their own portfolio?
Oh, sure. I mean, really, guys, you just got to ask. It's the idea is there's so many resources out there for people that have these kinds of things. Like I'm still learning to this day little tidbits about details involving real estate and depreciation that helps on an accounting perspective. So, the best way to do it is just, if you're not sure about something, just reach out to somebody and ask. You can ask me. You can ask Roger. I mean, you can basically just ask away. And if we don't have the answer, we can refer you to somebody that does. You want to be that resource for your clients to answer their questions, to assist them, to recommend things. That's why they come to you, because they want to not pay any taxes at all. That's what we all want in life. So,
well, at least legally lower our tax liability is how I like to say it. So that's
that's
what
one
we
way
want.
to say it. That leaves you a window, right? So
yeah, it gives me
perfect.
that nice little out, and I like it. Legally lower your tax liability. The last thing I'd like to just kind of hit on is you're looking at taxes and so forth. Are you still in the real estate world? Are you still investing? Are you still involved in that space?
So one thing I always say is, I would never lead you astray without knowing firsthand how things work. So yes, I have some single family rentals on the side. I have short-term rental investments. I'm invested in a syndication for apartment complex. So I've firsthand know what it's like to invest in a property. And one of my main things about investing is, I refuse to invest in any deal unless there is cost segregation or the massive accelerated depreciation taking place, because I'm more interested in stockpiling my losses on the side for when I have a taxable event in the future. So, personal experience, I've seen it all.
Very good.
It can walk you through some great stories.
Excellent. Well, this has been a pleasure. I've really enjoyed the conversation. I knew it was going to be fun. Cost segregation is one of those things that's just kind of that fringe topic that some people know or have heard of, but maybe not know enough to be dangerous. Right. And I think I'm dangerous. So that's where I'm at in the category. So let me ask one last thing. With regards to contacting you, I know that you've offered to give a free estimate. We're going to put in the episode description some information on how the listeners can take advantage of this. Is there anything you'd like to say about what they can find when they go to the episode description and take advantage of this? What is it that you're offering?
So, honestly, yeah. So we do free assessments, free estimates. It doesn't matter what type of property, how much, when you bought it, etc. The concept is nothing should be off limits, guys. I'm on every social media thing you can think of as, of course, the Cost Seg Cowboy. That name was not taken. So I'm every social platform you can think of. You can follow me there. Guys, I love talking about taxes. I love talking about real estate. It's a passion of mine. So even if it's just to call to chat, introduce yourself, whatever, I'm happy to have that conversation and see how I can benefit you and your clients moving forward.
Beautiful. Well, I appreciate that. One of the things I'm wanting to do here now is actually do a quick little summary of our conversation, and then I'm going to come back to you for a closing thought, see if there's one last word of wisdom you want to offer. But with regards to the summary, I've enjoyed this conversation. Speaking to the Cost Seg Cowboy has been a privilege, because I like the fact that he came not from the accounting space and is able to offer a unique perspective as it relates to commercial real estate, because he's come from that industry, and then he's come over to the cost segregation side, and he has those insights that he's able to offer us in the accounting space to really understand what we can leverage and use from a tax perspective. And as accounting professionals, I really do believe that this is a topic that we should understand. And hearing him explain essentially what is cost segregation, just as in layman terms, so that we can more explain to our clients what it is that we're wanting them to consider doing. I think that's very, very important. The other thing that I think is also helpful is that idea of the bonus depreciation, just kind of getting that accelerated benefit. And then obviously, with regards to the report, I like the fact that we're able to look at this at any properties, just learning the fact that even down to that smaller property, traditionally about $500,000 or more, but even perhaps less, that can all benefit. And learning that was, I think, a very important part of today's discussion, is just that you don't know what you don't know. And so with it, as it relates to cost segregation, I do want to just point out that I think there are some untapped opportunities that from a tax perspective, we as accounting professionals could lean into and become a little bit more creative for our clients, give them the added benefits of these properties that they already own or maybe looking at getting into, just to actually offset some of the tax liabilities that they currently have. And so if we can be a little bit more forthcoming with our clients, offer some of these creative options or opportunities, we just become much more of that star star in their eye, and as accounting professionals, really, I think, become much more valuable in the relationships that we have. Why? Because we're not just providing that historical report, we're now giving them that opportunity to do something proactively as it relates to their accounting and their tax liabilities. Now, with all that being said, Tax Cowboy Brian, what would you like to add here as a cost segregation cowboy?
Let's do one of the famous mottos of many CPAs out there. It in the real estate world, guys, it's at the end of the year, it has nothing to do with how much money you make. It makes everything to do with how much money you keep. So that's what we're all here for, and that's what we're going to try to strive to make sure the world knows.
Very, very good. Well, I appreciate those final words of wisdom. So here's what I'm going to do. I'm going to wrap this up by, first of all, encouraging you, if you've not yet subscribed to the podcast, I encourage you to do so. Definitely subscribe so that we can send out notifications to you of the next released episode. We happen to release those each and every week so that you can stay up to date and current with various things that you need to be aware of as you're running your business and trying to, in fact, offer quality accounting services, becoming what I refer to as the premier accounting firm in the area. Also, with regards to this, I invite you to go back and listen to our past episodes. We've got more than 200 episodes as of now that you can go back and listen to, various ones that are basically covering topics as they relate to your business that you can binge listen to and learn from the experts. In addition to this, I also want to invite you to GrowCon. GrowCon is an annual event. It's a live conference for owners of bookkeeping, accounting, and tax businesses. It's where at the conference we put on the stage those experts that we need to hear from. You get to meet and interact with your peers, individuals doing exactly as you have, and build some wonderful relationships and collaborate, basically cross-selling and offering different services so you can better take care of your clients. And then lastly, you can meet with us, the team from Universal Accounting, and see what it is that we can do to help you be in business for yourself, but not by yourself. All of that being said, at GrowCon. And then in addition, check out Universal Accounting. We have a great deal of free resources that you can take advantage of as you're working on your business there at Universal Accounting. And it's there you can also access the other podcast episodes. So I invite you to go to Universal Accounting. And then lastly, you can actually contact us about these principles and others by speaking with us directly at 801-265-3777 or visiting us at universalaccountingschool.com. Either way, we encourage you to do what you can, in fact, to offer these quality services. Why? Because accounting success is universal. Do take care, be safe out there, and have a wonderful day.